Hey there, it's Brennan from All Bookkeeping and Taxes back again. Yes, we're approaching the end of the year, and you know what that brings. Tax season. Naturally, one of the biggest questions on everyone's mind during tax season is, how can I reduce my tax bill as much as possible? Well, there's something you can do this tax season that doesn't require being a tax expert. This applies to sole proprietors, contractors, and freelancers, basically anyone filing taxes using Form 1040. Each year, you make a key decision about which deduction to take, and understanding this choice could significantly lower your taxes. If you want more details or need additional resources, check out the links to all bookkeeping and taxes blog posts in the description. We've got in-depth guides on both the standard deduction and the itemized deduction to help you. Now that we've got the basics out of the way, let's dive into it. Taxable income and deductions. Let's start with taxable income. Your taxable income is calculated by taking your adjusted gross income, AGI, from Form 1040 and subtracting your tax deduction. This is where the choice comes in, deciding between the standard deduction and the itemized deduction. Comparing the standard deduction versus the itemized deduction. Let's break it down. 1. The itemized deduction. The itemized deduction requires tracking certain expenses throughout the year. These include medical and dental expenses, state and local taxes paid, mortgage interest, charitable donations, losses from casualty or theft. At the end of the year, you total these costs to calculate your itemized deduction. We'll go into each of these categories in more detail shortly. 2. The standard deduction. The standard deduction is a fixed amount determined annually based on your filing status. Reintroduced in 1944, its purpose is to simplify tax filing. Today, about 70% of taxpayers opt for the standard deduction because it's straightforward. But does that mean it's the best option for you? Not necessarily. For example, the standard deduction for this year is $12,550 for single taxpayers, $18,800 for heads of household, $25,100 for married couples filing jointly. You just need to compare your itemized deductions to these figures to decide which option will save you the most. Calculating your itemized deduction. The Schedule A form on your 1040 is used to calculate your itemized deduction. This form is broken into several sections that correspond to different expense types. 1. Medical and dental expenses. Add up all eligible medical and dental costs for the year, including insurance premiums, exams, and tests. You can only claim expenses that exceed 7.5% of your AGI. For example, if your AGI is $50,000, only expenses above $3,750 will count. 2. State and local taxes. You can choose between claiming state income tax or sales tax, not both. For states with no income tax, like Texas or Florida, claiming sales tax is often the better choice. Other taxes, such as personal property taxes on cars, can also be included. However, the total deduction for this section is capped at $10,000. 3. Mortgage interest. Interest on mortgages used to buy or improve property is deductible. If your mortgage was taken out after December 15, 2017, you can only claim interest on the first $750,000 of the mortgage. For mortgages before this date, the limit is $1 million. 4. Charitable donations. Monetary donations, cash or checks, and non-monetary contributions, clothing, household goods, etc., are deductible. Deductions are limited to 60% of your AGI. 5. Losses due to theft or casualty. This section applies if you're filing Form 4684 for losses due to theft or property damage. Should you itemize? Before spending time calculating your deductions, here are 3 groups of taxpayers who typically benefit from itemizing. 1. Homeowners with large mortgages. If you're paying significant mortgage interest, it can push your itemized deductions above the standard deduction threshold. 2. Individuals with high property or sales taxes. Those who pay high property or sales taxes, especially through their businesses, may find itemizing worthwhile. 3. People with high medical expenses. If medical expenses exceed 7.5% of your AGI this year, itemizing might be the better option. Tips to prepare for tax season. Here's how to make this decision easier. Track your expenses year-round. Use a spreadsheet, Google Sheets, or Excel to log eligible expenses as they occur. This will save time when calculating deductions. Keep digital copies of receipts. Store receipts and records in cloud storage like Google Drive or Dropbox for easy access. By staying organized, you'll have a clear picture of whether itemizing makes sense for you. Final thoughts. For most taxpayers, the standard deduction is the simpler and more practical choice. But if you've had a year with high medical expenses, a new mortgage, or significant property taxes, it's worth reevaluating. Choosing the right deduction could save you money that you can reinvest in your life or business. For more detailed guidance, check out the blog posts on the All Bookkeeping and Taxes website, which break down these forms and deductions in depth. You can also follow us on Twitter at All Bookkeeping and Taxes, or subscribe here for more helpful tax tips. Thank you for tuning in, and here's to a stress-free tax season.